One rental at a time, family. This one's for you. So, Dustin, we've been talking a lot recently about rates, and that's kind of been the primary focus of everyone across the board. And you and I have kind of been on the same standpoint that hey, we don't know if rates are going to go up or down. Obviously, over the next 2 3 years, we're thinking it probably will tick down a little bit, but there's no guarantee, and we've said this to all of our clients. There's no guarantee that in the short term, this year in particular, that rates will drop as much as people are thinking they'll drop, right? What kind of is kind of going on in the market that's preventing rates from doing the big massive drop that everyone's expecting?
So we have been discussing this a lot, and we saw probably the lowest rates that we've seen at the end of December, 2023, and like the first week of January, all based on the sentiment right now is what the Feds are going to do in 2024, specifically the amount of rate cuts that they're going to do, and the first one being in March, or having essentially 4 to possibly 6 rate cuts in 2024. What we've seen in the last basically week and a half to 2 weeks is that now the market's starting to believe the Feds a little bit, and the Fed chair specifically, especially with some of their comments last week, that we don't have to, or the Feds are saying this, we don't have to raise rates, or pardon me, lower rates as many times or as much as we said we are going to do at the end of 2023. So as of right now, we've actually seen in the last 2 weeks rates go up about what, 0.2,
Yeah.
because of this sentiment. So right now, the biggest thing that's driving interest rates is the speculation on whether the Feds are going to cut rates in March and how much they're going to, cut rates. Um, what have you seen in terms of the differences between, like, our conventional lenders with, rates and their dropping of rates versus our non-QM DSCR rates?
I mean, conventionals dropped obviously the most, right? And in reality, a lot of our clients have been calling and asking about, hey, why isn't DSCR dropping about the same? Why is non-QM not dropping the same amount as conventionals dropping? And this is something that we've had a lot of conversations about. And for those clients that have spoken with me previously, I tell this all the time, right? The market is always forward looking, right? And in reality, unlike conventional loans, which is Fannie Mae and Freddie Mac, they're guaranteed buyers. Same thing with FHA and VA, Ginnie Mae, guaranteed buyers, right? The buyers on the non-QM side is Wall Street. And Wall Street is always forward looking. The market is always forward looking. They don't care about what's happening today. They don't care about what's happening yesterday. They only care about what will happen in a month, 2 months, a year from now, right? They speculate and bet on that. They don't speculate and bet on what's happening today. Now, the reason why we see rates move in the modern day, like at the day that something happens, is because of comments about the future, which is like, to be honest, right now, everyone was expecting rates to drop, and that was the sentiment, right? So we saw that drop happen, like Dustin said, at the end of December. But since then, with inflation data and everything coming out, it has been the opposite way, right? So Wall Street actually hasn't moved that much in their sentiment over the next year. They think that, hey, it's going to stay about the same, maybe lower a little bit, which again, they've lowered a little bit, but it doesn't mean that they're having the same drop that conventional is having because, and I've told other clients this, and I want to hear your thoughts too. If the Feds decide that, let's say, the next cut comes, I've been telling clients, if the Feds decide to even cut the rates a quarter, but they comment that, hey, this might be the last cut, or we're probably not going to cut 6 times, right? Then I've told clients, hey, rates, I believe strongly, will move the other way. And we've actually been very, like, a lot of people have been kind of doubting us because we've been talking so much about how we don't think rates will, drop as much as they will. Or last year, we were talking about how rates were jumping up and nobody was believing us when it first was jumping up, that we were like, hey, it's going to continue, right? So what are your thoughts on, like, what happens if the Fed say, okay, we're going to cut a quarter, but we might not cut anymore?
So if that were to happen, I think it's going to be a pretty seismic increase 2 minutes after the minutes are released in regards to rates going up. And like John said, The market, especially with mortgage rates, is always forward looking and looking at the future, and that's what drove rates so low at the end of December in 2023 was the fact that the market believed the Feds were going to move 4 or 6 times. Now, I think if you go back to a video that me and John did 2 months ago, 3 months ago with Michael, I didn't think even after the initial sentiment of 4 to 6 rate cuts from the market that we would see more than 2 to 3. I might be wrong, but we'll see. What I'm really eyeing and hoping, you know, uh, I don't know if I'm hoping for the fact that rates will be actually lower in 2024. I'm hoping that we, see maybe a quarter point, but I want it to remain consistent because it'll go into our next topic that if the Feds do really move, rates down half 0.75% by the end of the year, it's going to cause a problem even bigger, in my opinion, because it's going to bring a lot more buyers, a lot more, investors and even your first time home buyers, etc., into the mortgage market when clearly the bigger problem is our inventory problem. Inventory isn't going to get solved by this. Now we are seeing the costs for home builders start to go down, which will help a lot. But ultimately, the biggest problem I think we have, other than rates, is obviously the inventory problem. So with that, John, I think the audience would like to hear. I mean, right now, where are rates at this point, conventional versus DSCR?
Yeah. So obviously we can do both. DSCR has been kind of our main bread and butter, and that's actually dropped quite a bit from where we were last year, right? At a point we were doing without buying it down at like 7, 7, 8%. Now we're closer to 7%, right? Without buying it down. And if you want to buy it down, right, you can buy it down as low as 6% with like 2.5, 3 points, right? And again, this is for the perfect borrower essentially on a purchase loan, with LTV that's like you're putting 30, 40% down. And we like to talk about this bucket because this bucket I think is kind of the conservative bucket that lays the groundwork for the rest of the rates, because everything is just an added bonus on top of that, which means that obviously those loan level price adjustments come into play, but this is where the least amount of loan level price adjustments are in play, and we're able to kind of talk from a like a more general sense, because there's so many nuances that happen if you go the other route. So that's kind of where DSCR has been. Bank statement loans have kind of been about the same, right? And in conventional world, we've seen the biggest drop in investment side. Obviously, Fannie Mae, Freddie Mac, just being following the market every day, multiple times a day. We just priced out an investment loan at like 6.3, and the client wanted to buy it down to like a 5.3 with 3 points. And again, this was again with 40% down, but it's out there, right? It's happening right now in the market. So again, we are pretty like heavily imploring clients, like if you like the property, like the asset, and you can get it at the rate that it is right now, just get it. And then worst case scenario, rates drop later and it drops enough to make it worth it to refi, then just cost average down, right? Because you're not just investing in one property, you have to invest in multiple. This is the market where it's at, right? So how about conventional, Dustin, if you want to chat about conventional primary and FHA and VA? Because we have a lot of clients that call in asking about, hey, what if it is my primary? What if I'm trying to buy my first time home? Like, why is the inventory so tight and why is the competition getting tighter? It's because of what we're about to talk about on conventional primary and FHA primary side, right? So what are we looking at there?
So on conventional primary, your first time home buyer, I mean, par rate, with the same that John alluded to in terms of loan parameters, putting 30, percent down with good credit. You're starting at 6% right now on a 30-year fix, which is still, wild to say given where we were, 6 months ago. You can pay a couple points and get it down to, 5% too now on conventional, and FHA is around the same. I mean, the starting rate's going to be a little bit, lower because of the added, if you're doing FHA, PMI, but VA is always going to get the best rates. Those are at 5.5%. You can go as low as 4.75, with points. And I think one thing that we definitely wanted to allude to that we're seeing is on the conforming side. So conventional FHA and VA, we're seeing a pretty large bidding war going on amongst the people that a lot of you may hear or know on the radios, which is your Quicken and Rocket Loans, the Loan Depots, of the world, because what they're trying to do is they're lowering their floor rate, how low you can really go, um, to essentially entice borrowers, to pay the points, because obviously it's going to be a more beneficial, transaction for the lender when the client's paying points, based on the fact that they're betting, at least the lenders are, that they aren't going to refi, in 7 years. That sometimes may take these points to recover, which is 7 years. So the discrepancy though that we're seeing between conforming rates and non-QM rates alludes to what we spoke about earlier, that Wall Street is forward looking. Wall Street is holding tight to the fact that the Feds may not move in March, and that's why they are not moving rates as much as conventional is. And conventional lenders are, doing a bidding war to get as much as they can between now and March. So we appreciate your time, John. If anybody wants to reach out to us, how should they do that?
Go to convoyhomeloans.com and let us know you came from where at. I just wanted to end with one point though, right? Despite whatever the rate is, right, it's just the cost of capital, right? So we want to implore our clients to remind everyone, hey, it's just the cost of money. You can still make deals happen. You just need to do the work. So reach out to us if you have any questions. Thank you so much. Talk to you next time.